Your high yield savings account is about to get worse, and most of you are going to make a massive mistake because of it. I've been staring at the financial headlines all morning, and I'm seeing the same trap being set for everyday people. You've seen the news. The Fed is finally cutting interest rates. That 4.5 or 5% APY you've been enjoying on your cash for the last year, it's dropping. And now your brain is suddenly screaming at you to do something. You're looking at that monthly interest payment, that free money that's been hitting your account, and you're seeing it get smaller. Your instinct is telling you to panic. You're thinking, I need to move this money into the stock market right now, or I need to find a riskier private credit fund to keep that 5% return. Just stop. If you move your emergency fund just because the interest rate dropped to a point, you never understood what the money was for in the first place. You are about to trade your safety for a few extra dollars of yield, and in 2026, that is the fastest way to get wiped out. Today, we're talking about why falling interest rates are a test of your financial character, and why a boring account is your greatest weapon, and how to spot the good debt opportunities that are about to start popping up. If you want to stay wealthy while everyone else is chasing their tail, we need to talk. So, let's get one thing straight, because this is where the confusion starts. Your high-yield savings account is not an investment. I'll say it again for the people in the back. It is an insurance policy. We've been spoiled for the last couple of years, and we've got used to our emergency funds actually producing a return. It felt great, right? You check the app, see an extra $500 to $100, and feel like a genius. But the primary job of your emergency fund isn't to make you money. Its job is to be the armor between you and a cold, indifferent world. I think of my armor, and it doesn't help me deal more damage. It doesn't make me make more money, really, or make me do any more damage. It doesn't help me win the game faster, but it keeps me from dying when I make a mistake. Your cash is that armor. If interest rates drop to 0.01% tomorrow, literally back to the pennies we were getting 5 years ago, that money would still stay exactly where it is, even if it's earned absolutely nothing. It would still be serving its 100% intended purpose. Why? Because when rates fall, it's usually because the economy is shifting. The Fed doesn't cut rates because everything is perfect. They cut them because they're trying to prevent things from breaking. And when things break, jobs get weird. Hours at your corporate office get cut. Unexpected expenses pop up. If you moved your fund into a volatile index fund or some risky tech stock because you wanted a 10% return, and then the market dips 15% at the same exact time your car transmission dies, you are in a world of hurt. You didn't lose money because the interest rate went down. You just saw the bonus go away. The core value of that cash is its liquidity. It's the ability to sleep at night knowing that even if the Fed loses its mind, your rent is covered for 12 months. Don't gamble with your peace of mind to chase a percentage point. While falling rates hurt your savings, they make borrowing cheaper. This is the part where the financial community separates the amateurs from the architects. As rates drop, the world is going to start looking for suckers again. You're going to see 0% APR offers on credit cards. You're going to see personal loans at historic lows. You're going to see the car dealerships begging you to take a 1.9% loan. Most people see the lower rates and think, cool, now I can afford a bigger SUV. That is the average way of thinking, and it's how you stay on the hamster wheel forever. We want to look at debt through the lens of arbitrage. Arbitrage is just a fancy word for using somebody else's cheap money to buy something that pays you more. For example, if a bank offers you a 0% APR transfer for 18 months, and you use that liquidity to invest in a business, asset, or a high yield opportunity that returns 8%, you are essentially being paid to use their money. But, and this is a huge game-ending but, you only do this if your defense is already built. You never take on debt to invest if you don't have that 12-month emergency fund sitting in the background. Debt is like a high-powered explosive. It can clear a room of enemies, but if you don't know how to handle the blast radius, it's going to take you out too. When rates are high, we focus 100% on defense. When rates fall, we keep the defense exactly where it is, but we start looking for offensive opportunities, where the cost of borrowing is lower than the value of the asset. This is how the wealthy stay wealthy and don't panic when saving rates drop. They start looking for the sale on capital. Now, be careful, because as rates fall, the marketing is going to get incredibly aggressive. You're going to be bombarded with ads. Buy now, pay later is going to be everywhere, and you'll see influencers telling you to refinance your life or leverage your way to millions. The lure is designed to make you feel like you're missing out. They want you to feel stupid for having cash in a 3.5% account. They want you to move your money into their new revolutionary investment product that promises 12% returns but has zero liquidity. Don't bite. In 2026, the biggest threat to your wealth isn't low interest rates, it's impatience. We only use debt for things that appreciate or produce a cash flow. We never, under any circumstances, use debt for lifestyle. If the math doesn't result in you owning more of your time or increasing your net worth, it's a bad deal, no matter how low the interest rate is. The goal for this year isn't to have the most active portfolio, it's to have the most robust one. That means having your cash safe even if it feels boring, and having your eyes open for those 1 to 2 moments a year when the debt to investment opportunity is so mathematically sound it would be a mistake to pass it up. You can only see those opportunities if you are not distracted by the noise of the rate cuts. You stay in your lane while everyone else swerves off the road trying to find the next big thing. Now, I know it can feel like you're standing still while everyone else is moving. It's frustrating to see that interest income line go down on your statement. But sometimes the most productive thing your money can do is just sit there and wait for the right moment. You should always wait for the advantage. Your emergency fund is your life. It's okay, in fact, it's preferable if it sits around for a long time. Don't move your money out of boredom. Don't move it out of greed. Don't move it because a YouTuber told you cash is trash. Cash is only trash if you don't have a plan for it. For us, cash is freedom. Stay safe, stay average, stay automatic. If the interest rates fall, fine. My lifestyle doesn't change because my system is independent of the Fed. I'm still putting my percentage into the emergency fund. I'm still maxing my HSA. I'm still building the fortress. Because I know that when the chaos eventually hits, and it always does, the person with the boring cash and the low rate account is the only one who can keep their head. Now, if you got the discipline to stay the course and keep your money, and despite the rate cuts, awesome. Let me know how you're building your system and not just chasing a trend. If you want to see more of this, you can always go to saf-finance.com and go from there and see what you can find in the blogs. I hope this all works out for you, and I hope you all have a good day. Bye-bye.